Joining us right now is Stephen Parker. He is head of specialized strategies at JPMorgan Private Bank. And I got to ask you about comments from Jamie Dimon this morning, because that's kind of rattling around my head. He said the bond markets are priced for perfection. So is the stock market at these kind of lofty levels, right at a time when we think there's going to be a soft landing. And that's like the Cinderella-esque view of things. Are you convinced that things are at lofty levels when you look at the stock market?
So we do think that valuations are pretty full right now. That being said, we think that the macro environment, we're in an environment where growth is still pretty good, earnings are accelerating, inflation's coming down, and policy is getting easier. That should allow the corporate sector to continue to grow. That being said, we've moderated our expectation for what equity markets can deliver over the next 12 months. We think there's a little bit of upside, but we've pulled a lot of that forward. We're up over 20% so far this year, but that doesn't mean that you need to take any sort of significant action to de-risk your portfolio. We think you should be at normal levels of risk.
What if things turn down and the Fed says, okay, well, we've already given 50 basis points. We're only going to give 25. We're not going to do maybe as much as the market might have anticipated, that we've already started this?
So we actually think that our view is you're going to get 25 at each of the next two meetings for the rest of the year. We think that that's actually a positive sign because it indicates that the Fed doesn't see recession on the horizon.
That's what I mean. If the economy turns weaker, is the anticipation that the Fed's going to fix everything by going as deep as it needs to?
Well, I think the Fed is going to keep a very close eye, particularly on the labor market. That's obviously their big priority now that inflation has eased. And if we do start seeing a trend where labor is beginning to weaken meaningfully, which we haven't seen yet, I think the Fed would pivot. I think that they will get more aggressive. We think ultimately you're going to get to somewhere between 3 and 3.5 on the Fed funds rate by some point next year. But the Fed will pull that forward, and they'll be more aggressive if they need to.
How pivotal is this election in terms of what you see happening afterwards? Is there a divergence, or you think that this is going to be business as usual no matter what the case is?
I generally think that politics are overrated in terms of their impact on markets. And trying to make any sort of meaningful changes to your portfolio is a really difficult game. You have to predict who's going to win, then you have to predict how markets are going to react. Historically, it's been more about policy and not about party, but stocks have gone up in Republican regimes, in Democratic regimes, and more importantly, it's an opportunity to stay disciplined, stick to a plan. The biggest risk is for clients who think about making drastic changes to their portfolios because of some anticipation around the election. That historically leads to bad outcomes.
Are you playing this in the traditional playbook of what you would do when the Fed is cutting rates? Are you looking at those same stock plays, or do you think that this time is different?
We think this time's a little bit different, mostly because of that starting point around valuations that you mentioned. A lot of times at the beginning of a Fed easing cycle, you want to own the more speculative names, the companies that aren't earning profits, the smaller cap names. We think, given where we are in the market cycle, given where valuations are, our playbook is more to focus on quality, focus on higher yielding stocks. We think there's an opportunity there, not only because they've lagged some of the more growth-oriented names, but also because that income gives you a little bit of a cushion if we do see some volatility in the near term.